In 1851, a small group of businessmen in Rochester, New York, founded what would become the most powerful communications monopoly in human history. The New York and Mississippi Valley Printing Telegraph Company, later renamed Western Union, didn't just connect America with telegraph wires, they became America's nervous system. For over a century, Western Union was synonymous with instant communication. When you needed to send urgent news across vast distances, when businesses needed to coordinate operations, when families needed to reach each other in emergencies, there was only one option: Western Union. By 1900, they controlled 80% of all telegraph traffic in the United States, processing over 63 million messages annually. Their yellow telegram forms became cultural icons, delivered by uniformed messengers who carried everything from birth announcements to declarations of war. The company's telegraph network spanned 200,000 miles of wire by 1920, reaching every major city and countless small towns across North America. They were the internet before the internet existed, the social media before social media was conceived. Western Union didn't just deliver messages, they delivered the future, one telegram at a time. But by 1990, the telegraph king was already showing signs of mortal weakness. The rise of long-distance telephone service had been steadily eroding their core business for decades. AT&T's direct dial long distance, introduced in the 1960s, made voice communication almost as instant as telegrams, but infinitely more personal and nuanced. Fax machines, which became ubiquitous in offices during the 1980s, allowed businesses to send documents instantly without relying on Western Union's telegram service. The company's revenue from telegrams had plummeted from $400 million in 1960 to just $50 million by 1990. Facing this reality, Western Union had already begun pivoting toward money transfer services, launching their modern money transfer business in 1871, but dramatically expanding it during the 1980s as telegram revenues collapsed. They positioned themselves as the solution for immigrants sending money home, for people without bank accounts who needed to transfer funds quickly, and for emergency money transfers when traditional banking couldn't move fast enough. By 1990, money transfers represented 70% of Western Union's revenue, while telegrams had become little more than a nostalgic afterthought. The company had successfully reinvented itself once, transforming from a communications giant into a financial services provider. They had no idea they were about to face an even more devastating technological revolution. The first wave of the digital revolution hit Western Union like a slow-moving tsunami. Electronic mail, which had existed in primitive forms since the 1960s on university networks and government systems, exploded into mainstream adoption with the rise of personal computers and internet service providers. CompuServe launched commercial email service in 1989, followed by America Online in 1991, making electronic messaging accessible to ordinary consumers for the first time. By 1995, over 15 million Americans had email addresses, and the number was doubling every year. Email didn't just replicate telegram functionality, it obliterated the need for telegrams entirely. Where telegrams cost money per word and encouraged cryptic abbreviated messages, email allowed unlimited text at no additional cost. Where telegrams required a trip to a Western Union office or a phone call to dictate your message, email could be composed and sent from your home computer at any hour. Where telegrams might take hours or even days to reach remote destinations, email arrived in minutes regardless of distance. The world's largest corporations began replacing their internal telegram systems with email networks. Stockbrokers, journalists, and business executives who had relied on Western Union's premium services for decades discovered they could communicate more efficiently and cheaply through electronic mail. By 1997, Internet users were sending 2.7 trillion email messages annually, while Western Union's telegram volume had fallen to fewer than 20,000 messages per day. While email was dismantling their communications legacy, Western Union initially found comfort in their money transfer dominance. The immigrant communities and unbanked populations who formed their core customer base weren't early adopters of internet technology. Sending money still required physical locations, human agents, and cash transactions that seemed immune to digital disruption. Western Union operated over 100,000 agent locations worldwide by 2000, processing more than 100 million money transfer transactions annually, worth over $12 billion. Their network was particularly strong in developing countries where banking infrastructure was limited and internet penetration remained low. The company's executives believed they had found a sustainable niche in the digital age, serving customers who needed tangible, human-mediated financial services. This confidence led them to largely ignore the early signs of digital payment innovation. When PayPal launched in 1998 as a way to send money via email, Western Union dismissed it as a niche service for tech-savvy internet users. When online banking began offering electronic funds transfers, Western Union assumed their cash-based, agent-assisted model would remain essential for their target demographics. They were making a fatal error in understanding how quickly digital adoption could penetrate even the most traditional communities. The rise of the internet created an entirely new ecosystem for both communication and money transfer that Western Union failed to comprehend until it was too late. PayPal, founded by Peter Thiel, Max Levchin, and Elon Musk, initially focused on allowing Palm Pilot users to beam money to each other, but quickly pivoted to web-based money transfers. By 2000, PayPal was processing over $190 million in transactions annually, primarily among eBay users who needed a secure way to pay for online auctions. The service was faster than Western Union for domestic transfers, cheaper for international transactions, and infinitely more convenient since it required no physical travel to agent locations. But PayPal was just the beginning. Traditional banks, terrified of losing customers to internet-based services, launched their own digital payment platforms. Bank of America introduced online bill pay in 1999, followed by Chase, Wells Fargo, and virtually every major financial institution by 2002. These services allowed customers to transfer money, pay bills, and conduct financial transactions from their home computers 24 hours a day. The convenience factor was revolutionary. Instead of driving to a Western Union location during business hours, waiting in line, filling out forms, and paying high fees, customers could accomplish the same tasks in minutes from their kitchen table. Even more threatening was the rapid adoption of debit cards and credit cards for everyday transactions, reducing the need for cash-based money transfers that formed Western Union's foundation. Western Union's response to the digital revolution was characterized by corporate arrogance and technological timidity that would define their downfall. Despite seeing their telegram business completely evaporate by 2006, when they finally discontinued the service after 150 years, company leadership remained convinced that their physical agent network was an unassailable competitive advantage. They invested heavily in expanding their brick-and-mortar presence, opening new agent locations, and partnering with convenience stores, supermarkets, and check cashing services to increase accessibility. While this strategy generated short-term revenue growth, it fundamentally misunderstood how digital technologies were reshaping customer expectations. The company's first serious attempt at digital innovation didn't come until 2000, when they launched westernunion.com for online money transfers. But the website was clunky, expensive, and required customers to still visit physical locations to complete many transactions. Compared to PayPal's seamless user experience, Western Union's online platform felt like a digital afterthought grafted onto an analog business model. More damaging was their pricing strategy, which maintained the high fees that customers accepted when Western Union was their only option, but became impossible to justify against cheaper digital alternatives. While PayPal charged 2.9% plus 30 cents for most transactions, Western Union's fees often exceeded 10% of the transfer amount, plus additional charges for currency conversion and agent commissions. They were pricing themselves out of the market just as that market was exploding with new digital competitors. The smartphone revolution that began with the iPhone's launch in 2007 accelerated Western Union's decline into irrelevance. Mobile banking applications made digital payments accessible to demographics that had never owned computers, including many of the immigrant communities that formed Western Union's customer base. Suddenly, a Mexican construction worker in Texas could send money to his family in Guadalajara instantly using his phone, without taking time off work to visit a Western Union office, without paying exorbitant fees, and without the security risks of carrying large amounts of cash. Banks like Wells Fargo and Bank of America reported that mobile banking usage increased 400% between 2007 and 2010, with money transfers representing one of the most popular services. International wire transfer volumes through traditional banks grew by 250% during the same period, directly cannibalizing Western Union's market share. Even more devastating were new smartphone applications specifically designed for money transfers. Services like Remitly, launched in 2011, offered the same international money transfer services as Western Union, but with fees 90% lower and delivery times 75% faster. These applications didn't require physical agent networks because they operated entirely through digital infrastructure, allowing them to pass savings directly to consumers while still maintaining healthy profit margins. By 2010, Western Union was processing roughly the same number of transactions as they had in 2000, but their market share of global money transfers had plummeted from 18% to less than 8% as the total market exploded with digital alternatives. Perhaps most humiliating was watching former customers embrace digital solutions that Western Union could have developed but chose to ignore. Small banks and credit unions, traditionally Western Union's partners, began offering their own international transfer services powered by digital platforms. Walmart, which had hosted thousands of Western Union agent locations, launched its own money transfer service in 2014 with fees 50% lower than Western Union's rates. Even more symbolically devastating was watching tech companies effortlessly expand into Western Union's core markets. Facebook launched Facebook Payments in 2009, allowing users to send money through social media messages. Apple introduced Apple Pay in 2014, making smartphone payments ubiquitous among younger consumers. Google launched Google Wallet. Amazon introduced Amazon Payments, and even telecommunications companies like Verizon and AT&T launched mobile payment services. These weren't financial services companies competing on Western Union's terms. They were technology companies redefining what money transfer meant in a digital world. The final insult came from cryptocurrency advocates who argued that Bitcoin and other digital currencies would eliminate the need for traditional money transfer services entirely. While cryptocurrency adoption remained limited during this period, the mere existence of these alternatives demonstrated how thoroughly Western Union had lost control of the innovation narrative in their own industry. The numbers tell the story of Western Union's fall from dominance with brutal clarity. In 1990, Western Union processed approximately 30% of all international money transfers globally, generating $2.4 billion in revenue with healthy profit margins above 20%. By 2010, their global market share had fallen to less than 12%, despite the international money transfer market growing from $8 billion to over $440 billion annually. Digital payment platforms collectively processed more international money transfers in 2010 than Western Union had handled in their entire 160-year history. The company's stock price reflected this collapse in market position, falling from a high of $28 per share in 2007 to less than $14 by 2010, while PayPal's parent company eBay saw its stock price triple during the same period. Even more telling was the demographic breakdown of their customer base. Western Union's average customer in 2010 was 45 years old, had a household income below $35,000, and conducted fewer than 3 transactions per year. Meanwhile, digital payment platforms were attracting customers across all age groups and income levels, with usage patterns indicating much higher engagement and transaction frequency. The company's revenue growth, which had averaged 8% annually during the 1990s, stagnated at less than 2% annually between 2005 and 2010, despite global economic growth and increased international migration that should have driven demand for money transfer services. Western Union's transformation from the telegraph king to a digital refugee represents one of the most complete industrial extinctions in modern business history. The company that once connected the world through telegraph wires, that facilitated the California gold rush and coordinated the construction of transcontinental railroads, that delivered news of births and deaths and declarations of war, couldn't adapt to a world where communication became free and money transfers became frictionless. Their failure wasn't due to lack of resources or market position. Western Union had more cash, more international presence, and more customer relationships than almost any competitor when the digital revolution began. Their failure was philosophical. They couldn't abandon the physical infrastructure and high-fee business model that had made them successful for over a century. While email eliminated telegrams and digital payments marginalized money transfers, Western Union clung to the belief that face-to-face transactions and paper-based processes were irreplaceable human needs rather than temporary technological limitations. They mistook their customers' lack of alternatives for customer loyalty, and their monopolistic pricing for value creation. By 2010, Western Union had become what every dominant company fears most: a legacy business serving a shrinking market of customers who hadn't yet discovered better alternatives. The Telegraph King was dead, killed not by a single competitor, but by the democratization of the very technologies they had once controlled. In the end, Western Union's greatest strength, their massive physical network of wires and agents and offices, became their fatal weakness in a wireless world where the best infrastructure was no infrastructure at all.